Hello value investors, thank you for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today I want to talk about HIMS and HERS Health. So this is a stock that is presently trading at close to all-time lows, and it is a stock that I am long, so for the interest of disclosure I am long this position, and this is a stock that I'm particularly attracted to. So there's a lot more here than just a rapidly growing company. There's the fact that this company has come out and unwound itself in a kind of the de-SPAC trade. So we're going to get into that, what that means, and then we're going to talk about its valuation. So let's just dig right in. So anyone that's kind of interested in HIMS and HERS will probably know that the company is growing very strongly. We're talking about a company that's growing probably this year at 70% year over year. Okay, so it's it's one of those companies that is most likely going to be growing at more than 30% next year, which is what analysts are expecting from the stock. But anyway, that's jumping ahead. Let me continue to dig in here. So one of the things that it does right now is it predominantly has two categories. It sells drugs for males with erectile dysfunction or hair loss products. So these are predominantly the two categories that operate right now. But going into next year is going to have more categories. The big one that they're really focusing on is mental health. This is something that many other players in the space are trying to target, because this is like the new frontier to remove the stigma from talking about mental health and how do you disrupt the healthcare system so that you can see a patient on your you can see a physician on your terms, get the drugs delivered to the doorstep in a few days. So rapid onboarding, being able to see the customer from your house at a time that suits you and get the drugs into your doorstep in a few days. This is really what HIMS is about. And they're doing this quite well, and I can show here in the graph. So you can see here that it's a relatively young company. It's only been around for about 3 years. Now, you're not sure if you can see, but in the bottom line, the cream line, it shows the third year cohort. And you can see that from year 2 to year 3, they have an 88% retention rate. So it shows that once customers are acquired, even after the second year and into the third year, the customer still requires drugs from HIMS and still has approximately 88% revenue retention. So that's something that's really attractive. The other thing that I wanted to highlight is that cumulatively, over the 3 years, the first cohort, the 2018 cohort, spent $383 over those 3 years. So over the 3 years that they were on the platform, they spent $383. The newest cohort spent $363 in the first year. So the newer cohorts are very confident and comfortable in spending money on HIMS and HERS. So over time, the idea is that the amount that they're spending to acquire a customer, not only do they get that paid back quite quickly, but the customer continues to spend over time. So this is something that's very compelling. So even though the customer acquisition costs are going up, the lifetime value of the customer, you can see here in this graph, is up and to the right. Really what you want to see from a young company that's offering something that's kind of noteworthy. The other thing that I wanted to highlight is that they are investing quite significantly into these other categories. And what they're trying to be is an affordable health provider. And while they are trying to do many different things at once and they are growing their revenues at a rapid rate, they're not actually that EBITDA negative. So for the quarter just past Q2 21, it was negative 7% on the negative 7% on the EBITDA line. Now, as we look out for the full year, they're saying that they're going to be negative 16%. But for all intents and purposes, negative 16% on the EBITDA line for a company that's clearly growing at a very rapid rate isn't that bad at all. I think that this is something that, obviously I am biased here, but I think that this is something that's quite interesting. So many stocks have been through the de-SPAC trade. These are stocks that you can look far and wide, either to real estate, healthcare, gaming stocks, anyone that came in the back end 2020 and came in via SPAC has just totally unwind irrespective of the underlying potential. And you can see here that the business is clearly growing, and if you put aside all the negative sentiment, this is a business that is expected to be priced at 5 times next year's revenues. Now, just for comparison, Teladoc is priced at approximately 8 times next year's revenues. Now, Teladoc is A, expected to grow at 30%, B, it's also unprofitable, C, even after its acquisition with Livongo, if it's going to be growing at 30%, it's going to be very difficult at scale for it to continue to reignite and accelerate its revenue growth rates. Conversely, in the case of HIMS, it's really going to be very easy in my mind for it to grow at more than 30%, which is what analysts following the stock presently think this company is going to grow at. So I don't think it's going to be likely with this high retention that I already talked about, the high customer retention, that it's going to grow from growing at 70% this year to just 30% next year. I don't think that's likely. I think the company is going to really smash through analyst expectations, and I think that the stock is probably priced at actually closer to 4 times next year's revenues. And this is a high margin business, has the potential lower down the road to be reasonably profitable. So I think this is something quite compelling. I think that this is something that's worthwhile checking out. You'll see that I haven't made any kind of outlandish comments here. I mean, this is a company that I think that really has what it takes to not only be disruptive to the healthcare system, but give customers affordable healthcare solutions. And they're expanding to new categories too. So they have 2 new acquisitions in the pipeline that are going to be closing in the near term. So there's plenty of opportunity for them to really positively surprise investors with even stronger than 30 or 40% year-over-year growth rates into 2022. In any case, this is a stock that I do recommend in my marketplace. So if you want to find out more stocks that I'm kind of interested in my marketplace, don't forget to check out Deep Value Returns on Seeking Alpha. You're welcome to do a totally free trial to see if it suits you. You can cancel anytime before the 14 days if you see that it doesn't resonate with you, or if you're not wanting someone to kind of give you some ideas, okay, or someone that's doing the due diligence for you. Sometimes you just haven't got time, or you're kind of new to investing and you just want someone to kind of help you get some steady footing, and that's what I'm about. So you can come on board and chat in our marketplace and chat with our investment community of value investors, and really get involved and pick up new ideas all the time. And you can check out my reviews on my marketplace at Deep Value Returns on Seeking Alpha to see what other people have thought about it. So I've got 5-star reviews because people really find that I help them out in how to think about investing.